Hello and welcome to MMT Monday. So tonight we're going to talk about the history of the Federal Reserve. But first off, let's talk about money. You put it in the bank and it's there when you want it. But what if you went to the ATM and the bank didn't have your cash? Now I'm talking about more than just that lack of cash over the few days before payday. But as crazy as it seems, banks running out of money has happened numerous times in the past. You most likely picture the banks running out of money at the outset of the Great Depression. So because of the major booms and busts caused by the panics throughout our nation's history, the Federal Reserve came into being as a way to stabilize the financial systems. And this was the exact purpose of the Fed. Their goal was to provide short-term loans to banks to help keep them solvent during times of severe financial strain. Over the course of tonight's videos, we will give you a brief overview of the formation and growth of the Federal Reserve, from the Panic of 1907 to its formation in 1913 to its consistent growth in the century since. The Federal Reserve has served as not only a lesson in the fight between private and public ownership, but also as a preventative to help cushion the economic impact of natural disasters and other or unforeseen crises. We'll also hear from lawyer and founder of the Modern Money Network, Rohan Grey, who will take a deep dive not only into the history of the Federal Reserve, but also dispel many myths regarding the Fed as well.
The history of the Federal Reserve goes back before 1913 when the Federal Reserve Act was founded, and it had its origins in a network of private banks. So one can trace a story of the development of the Federal Reserve as one of increasing public ownership over the private banking network. So you can imagine the government allowing private banks to emerge, both at the federal and the state level, and then those banks developing sort of effectively network effects, and then the federal government taking over those network effects with the 1860 Federal Banking Act and keeping them. What happened at the late 20th century was and the banks started not trusting each other, and there was a sort of systemic breakdown like we saw in 2008, and the banks stepped in and created their own mini central bank and said, look, we'll provide our own liquidity, and we'll let each other settle all of our debts off against each other. And in doing so, we'll avert this calamity and we'll stay in control. And Chase at one point in the early 20th century was even the Treasury Secretary. So there was this sort of revolving door between the people at the top of the banking system and running the government. So there was definitely cronyism. There was definitely private interest involved. There was definitely corruption. Those claims about the sort of influence are not false. But technically speaking, the 1913 Federal Reserve Act was a creature of Congress, and it established a set of public institutions that, although they had, on paper, shareholder banks, were ultimately subject to government control. That said, that creation was a political compromise with financial interests at the time. So it was explicitly designed, and Peter Conti Brown, the legal professor, is a very good historian on this. He just wrote a whole book on it, I highly recommend, called The Power and Independence of the Federal Reserve. When it was created, it was explicitly a sort of compromise with private banking interests.
Money. You put it in the bank, and it's there when you want it. But what if you went to the ATM, and the bank didn't have your cash? It happened in the past. And that's why the Federal Reserve was created, to keep the financial system stable. The Fed provides short-term loans to banks so they have enough money on hand in times of financial stress. But travel back in time to before 1913. No one was responsible for the health of our banking system. There was no lender of last resort. Why? Because from our country's earliest history, some people opposed a central bank. They feared it would put too much power in too few hands. But as the country grew, frequent banking panics kept the economy on a roller coaster ride, complete with ups and downs, chills and spills. The last straw came in 1907, one of Wall Street's largest financial institutions, the Knickerbocker Trust Company, went bankrupt. Panic was widespread. People raced to withdraw their savings, only to find that banks didn't have cash available. Financier J.P. Morgan and a group of investors rescued the economy with emergency loans to banks. But it was clear that relying on wealthy individuals wasn't the right long-term solution for the nation. It was time for a change. The United States needed a strong central bank that would keep money flowing during times of crisis and help prevent bank runs. To keep power from being concentrated in Washington or Wall Street, lawmakers spread control across the country. The Federal Reserve Act of 1913 established 12 independent reserve banks, in addition to a board of governors in Washington. The structure would insulate the Fed from partisan politics and powerful financial interests. Over time, the Fed learned how the supply of money and credit affects financial markets and the economy. By the 1950s, the Fed was working to counter the ups and downs of booms and busts and limit inflation. In the late 70s, a new crisis hit.
Bad news on the inflation front. Wholesale prices were up again in February.
High unemployment with high inflation challenged America and the Fed. Oil price hikes and poor policy choices made the situation worse. In 1979, Paul Volcker was appointed Fed chairman. Volcker and the Federal Open Market Committee put the brakes on inflation. They reduced the growth of the money supply and raised interest rates. Once inflation was back in check, the economy started growing again and unemployment fell.
Breaking news here. Stocks all around the world are tanking.
More than 500,000 Americans lost their jobs last month. That is the worst month for job losses.
More recently, in 2008, the Fed responded to the largest financial crisis since the Great Depression. Many major financial institutions were on the verge of collapse. Unemployment skyrocketed.
The Federal Reserve is more than happy to try to work with you on
The
specific.
Fed made emergency loans to stabilize the financial system, and then purchased bonds to lower interest rates and help stimulate the economy. Though the Fed wasn't able to prevent what has been called the Great Recession, its actions helped keep the situation from being much worse. Beyond financial crises, there will always be unforeseen events and natural disasters. The Fed can do a lot to cushion their economic impact and keep money flowing. So the next time you reach into your wallet or drop by an ATM, take a look at one of the bills and find the words Federal Reserve Note. And remember, the Fed's goal is to help keep the economy healthy.
What became clear over time was that the most important power was the power over interest rates, and that increasingly got centralized. So at the beginning, those regional banks were public institutions, but they were mostly staffed by private banking interests. And then those private banking interests had an alternative power base against which they fought in Washington, D.C. with the Federal Open Market Committee. And that Federal Open Market Committee ended up winning that fight in 1935, which at that point, the decisions to set interest rates were made exclusively, effectively in D.C. Now, that fight was fought mostly between the New York Fed and the D.C. Fed, because the New York Fed was the one responsible for doing most trades involving Treasury debt. So they were the ones, like we were talking about QE earlier, they were the ones that were monitoring and controlling the membrane between Treasury debt and cash, and how much gets to slip through one way and how much gets to slip through the other way. They retained control in DC, even as they might have had banking interests, play in their policy decisions. And the big fight then came, funnily enough, between the DC board and the Treasury. So as I was saying, if you can imagine this sort of history of an increasing of taking of private banking power and moving it closer to the public institutions, the creation of the Fed was a step forward in that trajectory. And then the creation of the Federal Open Market Committee on top of the regional banks was a step forward in that process. And then the fight between the Federal Open Market Committee and the Treasury Department was a step forward in that. It was bringing this power closer and closer to, the President and the Treasury Secretary. And what happened was the Treasury Secretary said it's war. And because it's war, we want to make sure we're not paying too much interest on the national debt, because paying interest on that debt is effectively giving fiscal subsidies to owners of that debt. They're just getting interest for holding out, for lending us cash and getting a cash-like instrument in return. So keep the interest rates pegged at 2.25% at the very long end, and keep it pegged at something like 0.3% at the very short rate. So what this did was make very clear that those interest rates were a policy decision of the Federal Open Market Committee. If they said we want long rates to be 2% and we want short rates to be 0.375%, they had the tools, they had the power with their buying and selling, because of that infinity sign, to back that up. And the markets didn't fight them. The market said, look, we know you can back it up. We're not going to go fight. It's like a computer game where there's an evil character that's invincible because he's important to the storyline. You don't keep trying to attack him. You just move on. They didn't keep trying to fight the Fed. When the Fed said the interest rate is 2%, it stayed there. Of course, the bankers hated this for two reasons. One, 2% is not that much interest. And two, it makes it very clear that the private bond market is not financing the government.
As you can see, the history of the Federal Reserve is really a history of private banking power consistently taking steps towards becoming a public institution. Rohan Grey discussed how the creation of the Federal Reserve being that first step forward. The second step occurred with the creation of the Federal Open Market Committee on top of those regional banks. The third step happened with the major infighting between the Federal Open Market Committee and the Treasury Department during the Truman administration. And so all of these steps culminated with the centralization of power at the federal level with the President and Treasury Secretary. And so this all leads us back to one of our original questions, and that is, who really owns the Federal Reserve? On the one hand, yes, it's owned by private interest in the sense that, yes, banks and private interests possess immense influence over the actions that the Fed takes. But on the other hand, the Fed is not a private institution. The Federal Reserve Act established it. The members' banks are publicly chartered institutions. And the bureaucrats that run the Fed are public employees bound to oversight by the federal government. Overall, the history of the Federal Reserve is not simply a financial institution that was used to bail out the government when financial crises occur, but rather it's an intricate history of an all-out war over power between the private and public interest. So, if you enjoyed tonight and want to learn more about modern monetary theory or real progressives, make sure to hit that like and subscribe button below, and make sure to also check out our website. Y'all have a great night.